All right, I think we're live. All right, so Jake and I were just discussing a question that Jake asked me. So we decided let's just start the stream. So, hello everyone. Welcome to Stock Talk episode number 57. Big day because Jake is in a brand new apartment. And the Fed just cut interest rates. Stocks are at all-time highs. So, Jake, would you like to ask your question again? If you remember it.
Exactly right. Yeah, good morning, everyone. Good afternoon. So both yours and my portfolios are at all-time highs. And I came in, was basically like, hey, man, how are you feeling? A lot of your stocks that you have been talking about, that you've stayed convicted on for a while, that people give you tons of crap for on the internet, they're doing well, EQB, Brookfield. And it's just a general question, like, how are you feeling about this?
Yeah, so my response was going to be, it's weird because, like, obviously you like to see your stocks go up and you like to see your portfolio growing, everything hitting all-time highs. Like, that's the goal of investing, right? But then at the same time, when your stocks go up, it's like, well, now they're just not as cheap. So now I can't buy them cheap anymore. And that's like the catch 22 I'm in. Like, yeah, I like seeing my stocks go up, but at the same time, I'm like, well, I wish I could keep buying them cheap though. So that's where I'm at. How about you?
Interesting. I thought that you were going to take more of the psychology angle on it, because I think the default reaction is just like, oh my gosh, I feel great. This number's going up in my account. Like, everything's rosy and merry. And this is also the time where I find that some investors on both sides of the coin, they actually make a mistake if they have not been investing to try to like play catch up because they like feel something running away from them.
Yep.
And I guess for you and me, where we have been disciplined in buying while things are low, there's like a flip side of that you had already described. So I start playing games with myself back and forth. Like, I'll start feeling happy, and then like the Jekyll Hyde comes in, says, hey, you probably shouldn't feel so excited. I mean, the market could dump tomorrow, right? And then your emotions really going to be like tied to these stocks. So it's forever like finding the balance of celebrating the wins while not being emotionally tied to your portfolio. Because if you get super high on the fact everything's going up, well, what's going to happen on the flip side when things go down, and it's not always in your control. So yeah, that's the other side of it that I think about as well.
Yeah, and like, just because things are at all-time highs doesn't mean everything is expensive. You know, like I actually think that there's still a lot of really undervalued stocks in the market, which is why I'm fully invested. Like, I have probably 0.02% cash right now, and like, I'll continue buying. I really don't care that the S&P is hitting an all-time high right now. Like, if I got $3,000 today, like, I'd buy stocks. So that's how I think about it too. Like, I'm not really like overly worried that the market's at all-time highs because, well, one, I think I only hold two stocks that are actually in the S&P 500, which are Amazon and Google. And then like all the rest of my stocks are their long-term performance should not be tied to the S&P at all. And their valuations are not tied to the S&P at all. So I guess that's a long way of me saying, like, I actually don't really care what the S&P does. I'm just going to continue investing and buying cheap stocks because I think there's always cheap stocks, and that's what I'm doing.
I do agree with you that there is always value somewhere, and that when people say the market is too broad, I would be interested to see what some people in the chat have to say to this question, because I'm going to ask the chat question, and I'm going to ask you the same question, Daniel. I am curious in the chat what percent cash people are, and if you don't have the exact number, oversimplifying this to, do you ever feel comfortable having almost no cash? Is there ever a time to be 100% invested? This is obviously an opinionated question with no right or wrong answer. So Daniel, it did surprise me when you said, not only are you close to 0% cash, but if you had cash, you would still be buying.
Absolutely, yeah. I'm going to be buying stocks not my next paycheck. Absolutely. Why is that surprising?
Well, there's two sides to this. One is just more of a like, and I know that we're getting too specific, like, do you have an emergency account? Like, is 0% cash like actually zero? Are you saying like 0% cash in your investments? And then like on the flip side of that, collecting like the yield off of the cash at whatever the interest rates are. So like right now you can get 5% versus like going into the market. My take on this is I'm more of like a shotgun blaster generally with stock buys. Like I will dollar cost average into things, but I am actually sitting at around 17% cash now. If you were to ask me why, it's because I like the safety of the yield. I have been moving to a new apartment. There's some big things happening in my life that cost a lot of money. So everyone's like situation is different. But based on, getting closer to like 5 years investing now, I have seen a lot of like very rapid drops. And there have been times where I did not have cash where the deals got better than I thought. So sure, you could say like semi-timing the market. So like I kind of blend like dollar cost averaging in while keeping some cash, purely like for my style. So I don't mean to throw shame or be like, why would you do that? It's more so like learning a different perspective here. And it does look like we have some people coming into the chat too, talking about their cash investments.
Yeah, Crispy Chicken said, funny name by the way, 0% as of last month. I'm here for the long run. Yeah, that's my. And then he also said, aside from my emergency funds, lol. So like, yes, I do have some money set aside for emergencies. As you know, I have been caught in those before. So I do have money sitting around for an emergency. I actually need to get a leak fixed in my house tomorrow. A plumber's coming by. So like that's going on. But in terms of my investment portfolios, I probably have like $30 across all of my portfolios right now in cash. So like it's in terms of my investments, like yeah, I am in the market.
Awesome. And it has been working as of right now today. That has been working out. So kudos to you there. It looks like most of the people in the chat are fully invested as well. For people listening to the recording, we do these live. So if you can't see what we're looking at, there are live chats coming in.
Yeah, but like as I said earlier, I'm someone who believes that there is always value in the market. So if I think that a stock is cheap, I try and think of like the Warren Buffett mentality where it's like, yeah, sure, if there's an S&P 500 crash, like that should bring everything down just because people panic. But like if something's cheap, you shouldn't hold off buying it because it may become cheaper if a crash happens. Like if something's cheap, I'm in the mindset of just like I'll just buy it, and then if it gets cheaper, like I have cash flow coming in every month from our salaries and whatnot, so it's like I can just continue buying. So I think it's because I have cash flow coming in and I can just continue buying stocks that like I don't really care if I'm fully invested because if things go down, like in 2 weeks I'll have more money to buy. It's like it's not a big deal.
Yeah. I feel like I'm thinking about like Airbnb for me as an example here. Like there's only really been two stocks I've been buying the last few months. I've been dollar cost averaging into Airbnb as well as Amazon. Haven't really like bought anything else yet. And Airbnb is a little more of a volatile stock. The market doesn't really know what to think about it. So it actually hit highs close to like 160-ish. And I was sitting on a lot of cash. And I did ask myself at that time, hey, it keeps going up. Why have I not been fully invested in? Like, let me just go into things that I think are like great companies. Airbnb fell from about 160 to around 113 was its low. That was like last week. So because I was sitting on cash, and again, I don't know if this is right or wrong, but like psychologically to me, like it felt good where it's like, okay, I can now go in more heavily. When I say heavily, that's like 2 or 3 shares at a time instead of one.
Yeah, I know. Yeah.
But yeah, if you look at like my transaction list, it is hilarious. Like 1111112 111. But yeah, it does feel good to have cash on the sidelines when things do dip back down. But I argue with myself on it because I also tend to not try to time the market. But I think my actions are different than what I say. Because if you look historically, I do time the market a little bit.
Yeah. And I mean, my whole philosophy is that there's no one right answer. It's like, what makes you comfortable? Like if having some cash sitting around makes you comfortable, then like that's probably the best decision for you, because discomfort leads to emotional decisions, which in investing is almost always a mistake. So like if you're someone who having 20% cash makes you comfortable staying invested long term, and then if you were that same person and you had 0% cash and you're like freaking out, can't sleep, your stocks drop 1%, you're like, oh my God, what's happening? Then like for that person, then absolutely having cash is a better investment decision. And it's just like, that's what it is. But for me, that's definitely not what I would do, and that's not best for me.
Yeah. One thing we can all agree on, I'm going to share my screen here, is our company, everyone here knows what it is. Daniel and I are building Stock and Lock, which is an investment platform.
The best one.
We are getting more and more pieces of feedback like this. Let me just bring this up. Andrew here, who also mentioned liking the streams, which is great. By the way, almost up 50% since joining Stock and Lock this year. We are getting like more and more messages like this, and we're going to try to use them in our marketing more. But yeah, I have seen that like our software is helping me stay level-headed and rational, and people are still not really thinking about it from the right angle, in my opinion, where Stock and Lock is not, sure, it helps you find good research candidates, but it's really helping you like avoid money on stocks that are garbage. I know like your classic example is like Beyond Meat, but pre and post Stock and Lock, I have avoided so many losses by just using the insight score and all that. So just wanted to shout out to everyone who is currently supporting us. As we support you with great software, you have probably noticed a lot of great updates. Daniel, I'm not sure if we should talk about or tease anything that we have coming up. It's totally your call. I think like financials tab stuff is interesting. If there's an example portfolio update to run through and some of the new UI there, that would be great. Or we can keep it as a secret.
The financials tab stuff, Addy, who's I think is watching the live stream right now, they asked a really good question. I'm going to answer Addy's question here soon. Addy is our new designer, full-time designer. Absolute friggin' stud this man is. I'm extremely excited. They just joined our team. And yeah. Anyways, that was a long way to say that the financials tab is not at a place where I'm comfortable sharing it.
Fair enough.
Yeah.
But you did just name drop. We hired a designer this week, full-time designer this week before we had part-time. So the team is growing here.
All right, crispy chicken. All right, friggin' fine. I'll show you guys some secrets. Let's go.
Is the last name supposed to be pronounced as chicken? Because I always just thought it was crispy, and then I just like spelt it out like psych-n.
Kickin?
And kickin? Let us know, crispy. How do you pronounce this? Is it chicken? Is it chicken?
It's actually not chicken, but I've said that for a while now.
No, we just got confirmation. It is chicken. I've been reading. Yeah, well, you see this screen. I've been reading that name for 2 years, and I cannot believe I just figured that out. So I'm just going to marinate on that a bit. But what are we looking at over here, Daniel?
We're looking at our updated designs for Stock Unlock's portfolio tracker, which, if you're a Stock Unlock user, you will probably have noticed that like things are changing as time passes. Like this top thing was launched, and these new charts were just launched. This is not launched yet, but that's something. We're also making an events calendar.
What is that above, Daniel? I see some green, I see some red. Like as an investor, why should I be excited about this? Because it's hard to see some of the text on the screen.
Oh, this is going to be like how did your portfolio perform every month historically? So you can see like for these 4 months, your portfolio was down. And then for these 4 months, your portfolio was up. And then maybe we can even add in like a SPY comparison there. But this is just kind of like a monthly view of your historical performance. And then new tables, some new charts over there. Our valuation tab, which is not designed at all. Or sorry, not built at all yet. This tab in the portfolio is going to help people find value in their stocks. So like which stocks are currently down, which stocks are trading below their historical price ratios. So like if you're looking for ideas on where to find value within the positions you already own, this entire tab and all these features are going to be dedicated to like basically helping you find stocks that could be looking interesting or stocks that just might be looking cheap in your portfolio. I don't want to reveal too much there because I think there's more work to do.
Yeah, I think this is a great teaser. As a summary for people joining, we have not only been redesigning our portfolio tracker to make it easier on the eyes, but adding a lot more features.
Yes.
So you're just seeing the tip of the iceberg there. Thankfully, we have scaled stock and lock subscriptions, we still have a long way to go, but we do have a full-time team of 7 now, which is absolutely wild to think about. Because last summer, when Daniel and I were doing this, there was a time where it was just him and I. I believe back in last July and August, a third co-founder left. So for everyone who has stuck with us through the good times and the bad, seriously, shout out to you.
Yeah.
You cool to switch gears here towards a stock analysis?
I want to answer Eddie's question. So he said, what do you guys think about Warren Buffett holding billions in cash right now? It's at an all-time high. Yeah, so I think Warren Buffett, the Berkshire Hathaway cash position is well over 200 billion now. It's the highest it's ever been by far. He just sold 50% of his Apple position, which was the largest position in the Berkshire portfolio by far. It was a massive sell, like $86 billion sold in Apple, like huge. So yeah, a lot of people are speculating that this is Buffett saying there's going to be a crash or preparing for a crash or whatever. Two things. First thing, I don't think that Buffett should be a reflection of the average person or the average investor. This guy is literally managing hundreds of billions of dollars. And he said that his universe of stocks that he can even buy or invest in is like a few handfuls of companies now. So like maybe 50 companies Berkshire can like actually seriously look at investing. So like Buffett's world of investments is so small now that, you know, like me as an investor, I can buy 20,000 different stocks tomorrow if I want. So like my area that I can actually invest in is 400 times larger than Buffett's or something like that. So
yeah, and
I just to finish off that though, like I strongly believe that if Buffett was managing a $1 million portfolio today, he would have zero cash. He would be fully invested in stocks. Like that's always how he's managed money when he was a smaller investor. It's just now he doesn't know what to do with his cash. That's my opinion.
yeah, it's interesting that they were almost like a victim of their own success. I found it so interesting I forgot which position it was, but they got special approval. I think it was probably from the SEC to like build the position without filing forms saying they were buying it for the optics of not moving the market for two reasons. One, just the size of the buys. Like you can't just go and like make a TD account and like do a $80 billion transaction. You have to work with real people to do that. They're actually managing your account. They have to like find all the orders and it takes a while to fulfill and all like the share lots. So that was like very interesting to me. And then the second one is just more simply like, they're not really going to move the needle on a like $50,000 investment. Like the amount of overhead and work, even if that 10x on them is maybe like a 0.5% change in some of their like bigger ones.
Yeah.
And I do wonder how Buffett, like I want to ask Buffett how he feels about this, because I imagine he's still a nerdy investor like us and probably is not thrilled about the situation he's in, which is again, a victim of his own success. Just like a weird oxymoronic thing that happened there.
Buffett does have a private personal account and he has talked about it before. And I think it was within like the past 5 years, he was buying Korean stocks and he went back to his like initial investing days where he would go and try and find stocks selling below book value. Apparently there was small caps in Korea trading for like a third of book value, like 20% plus earnings yields. And apparently he bought like 13 of them in his personal account and just like dumped his money into these Korean stocks. And then he was like, it worked out very well. It still works. You can still do it. So like, I think that he's still the guy, you know. And to put this in perspective, like one of my largest stocks in my personal portfolio that I don't talk about publicly because it is a smaller company. When I first bought my position, it was a 200 million Canadian dollar market cap company. So to put that in perspective, like I can easily put my entire portfolio in that stock tomorrow if I want, right? Like that's no problem because I'm working with a small amount of cash. But for Buffett, a $200 million stock, he could buy that entire company and it would be like 0.1% of his portfolio or probably lower. So it's like, for me, I think that company was a great opportunity. So I put like 8% of my portfolio in it in a day, no problem. And it's going to like, I'm up quite a bit on it. Like it works, it's worked out well so far. But for Buffett, like even if he bought the entire company and that company 10X's, he's going to make like 1% on his portfolio. So that's what I mean. Like the circle of opportunities for Buffett now that will like actually move Berkshire's needle is just so small. So like he's at a massive disadvantage to someone like me.
Well, I've learned two things from this conversation. One, you're not worth tens of millions of dollars.
No.
Thought you might have been, but haven't gotten there yet. And then two, I cannot rationalize my thought process of liking to sit on some cash always and equate that to Buffett has cash and I have cash, which means that Buffett agrees with what I'm doing. I think that you accurately called out, and there's a really good comment here in the chat too that I'll bring up on this, that Buffett no longer is and hasn't for decades been any type of investor that people like us can follow, just simply based on all the points we made about scale. This is also a great one too from Paolo PG. Great to see you again. Buffett also runs an insurance company and needs to have cash to pay for claims in case of a major correlated risk event.
Yep.
So there you have it.
Yeah, I think at Berkshire's current size, he said it's like 50 billion has to stay in cash just to manage the insurance business. So that's also like, you know, it's a lot of cash he needs to keep around, but he still has like an additional 170 billion on top of that right now. And I genuinely don't know what he's going to do with it. I don't think that he's like trying to time the market. I just think he doesn't know what to do with cash anymore. And it's unfortunate. He's been warning about this. It's funny. I'm reading the Berkshire Hathaway letters like all the way back to 1970, and I'm just reading them one by one. And around 1980, Buffett was starting to warn people like, hey, we've compounded our business at 23% annually for like 20 years. Like, it's crazy. We probably can't do this forever. And you guys should be expecting your returns to slow down. He still says that today. I think it's more true today than in the 1980s, but like, it's funny seeing him say that in the 1980s. And then like, you look from 1980 to 2022 or whatever, and it's like, he ended up managing to compound the business still at 20% for the next 40 years, which is insane. But yeah, I think that Berkshire is finally at the point now where like, I don't think they're going to be able to compound at 20% going forward. I don't see how they can do it.
Agreed. Well, switching topics slightly here. No one has mentioned this, which I actually like. I want to claim that we are the only investing show on the internet that has went live or spoken in the last 24 hours that has went more than 1 or 2 minutes without bringing up the interest rates. Every single investing newsletter I subscribe to is talking about Jay Powell. I'm seeing memes with him with wigs on. I'm seeing people take political stances on this, saying, oh, of course they did this, you know, like the Democrat, like the election's coming up. There's other people coming in saying like they waited way too long. This has nothing to do with politics. So what we won't be doing on the show is talking all about that. But I think the reason why is more important. So just to remind the viewers here and anyone who's new, Daniel, let me just ask you, do you care about the interest rates from the Fed in your own investing? And if you do or don't, just a quick 60-second as to why.
I don't care at all. And my whole messaging that I believe I've been very consistent on is, I don't think that you should change around your portfolio. I personally, in my portfolio, don't think that I should change around my portfolio based on what interest rates are doing, because the stocks and the businesses that I own, I believe are very high quality. And therefore, whether interest rates are high or low, they're going to be fine. The businesses are going to be fine. They're going to grow. When interest rates are low, they may grow quicker, but that doesn't mean that I should be making moves in my portfolio. So like, my thing is, if your business or the stocks you own cannot succeed or thrive during high interest rates or low interest rates or whatever, then in my opinion, that's not actually a high quality business. And to me, that's not a company that I would want to own. Like, I don't want to have to change my portfolio because, oh, this business is going to do worse or significantly worse or not be profitable if interest rates are at 5%. If that's the case, that business sucks. That's not what I want.
Yeah, it looks like we have some agreement here from Yerd. I don't have too much to add there. Again, Daniel and I are not financial advisors. This is not financial advice. If you're playing the stock and lock bingo game, yes, take a drink for that. Cheers. But yeah, I couldn't agree more. And let me put my conspiracy theory hat on, which I love to do. Retail money is called dumb money in the big world of finance. I live in New York City. That's like not a conspiracy, that's a fact. Like retailers traditionally are called dumb money. And when hedge fund managers and people are talking, that's what they're doing. CNBC, all these other big news organizations, are very, very heavily influenced by big money. And you'll often see hedge managers go on CNBC during live trading hours, talk their shop, say the market's going up and down. So this is my message, again, not advice, it's my opinion to all other retail investors in the chat. Do not fall victim to the propaganda of all the hoopla you see about interest rates rising and falling, different analysts or banks or Chase or Barclays or whoever the heck it is making predictions about the economy. If you look back historically, you probably already know this, everyone tried to predict the economy through COVID and everything, what would happen this year, recessions. Every single person was wrong. If you have been listening to these people, you would have lost money. And my main message here is think for yourself. Softwares like Stock and Lock and other tools out there as well really give you the peace of mind and data to focus on individual businesses, make investing decisions for things that you can control. Because I can promise you, you can't control the interest rates. And if you try to learn from analysts or like just news articles, it's just going to be a confirmation bias. So yeah, I could not agree more. I actually feel bad for all the people on FinTwit like screaming and crying about the interest rates, because it feels much better to be in our shoes where our businesses that we own are doing well regardless of the rates. So again, not financial advice, but that is our stance on it.
Yeah, I honestly did not think that the interest rate decision was going to be such like as big as it was on social media. Like I posted a video on Adobe yesterday, and then I looked at my YouTube feed, and it was like every single finance channel was like, rate drops, rate drops. Oh my God, the economy's flipping flames. Oh my God. And I was just like, and then I posted a video on Adobe, and like it did not do well. And I was like, I clearly am not in tune with what people care about, because I don't care about interest rates, but every other channel was just like pumping out interest rate content. And that's what was getting views. My video did not get views. So I missed the target there.
You gotta pick what game you want to play, right? Are you going to succumb and take a knee to the YouTube algorithm gods and just bend your personality? I would say as a viewer that one of the reasons why you are the only YouTuber I've stuck with for multiple years is because of the fact that you don't really follow those trends. So hats off for me, but I know that you're also playing with the algorithm to get ad money and stuff.
Yeah, like I'll make a video on my thoughts on everything, and I'll try and be like the logical voice. But yeah, I did not see the big deal yesterday. And then another thing that I found interesting was like stocks were going up. Everyone was like, oh my God, interest rates are going to drop. Stocks are going up. Market's at all-time highs. And like when interest rates drop, oh my God, the market's going to continue rising, which is what it's doing today. But then when interest rates dropped yesterday, then I started seeing content coming out that's like, now the market's going to crash, because historically when the Fed lowers interest rates, stocks go down massively over the next 2 years. And they're like, it happened in 2007, it happened in 2020, it happened in 2001. So lowering interest rates now is actually apparently a bad thing. Whereas like the past year, everyone's like, lowering interest rates means the market's going to hit all-time highs. And now like that's just totally flipped. So I'm like, these influencers, bro, I can't.
It's the propaganda from big money out there trying to get dumb money to be emotionally reactive. So anyways, happy that we have our little curated oasis here in the Stock and Lock community. It seems like people in the chat too are kind of on the same page with us. And look, JD, been following you since 2020. Seems to be a fan of your content. So don't listen to the YouTube algorithm haters.
Yeah, I agree.
There was one stock in here from Yurd. It seems like you're still here. I was actually surprised that this wasn't PayC, but I don't think that we've done this one yet. So let's do a quick analysis of this stock. And then for anyone watching with us live, drop in the chat, let us know what you'd like us to talk about. We are at 30 minutes in, so I'll probably be here for another 15 or so. Unfortunately, just do this once a month, and I look forward to it. I'm actually traveling to Europe tomorrow. I should have mentioned that, which is why this is happening on a Thursday, not a Friday. All right, let's look up CPay. I love this new sidebar too. Everything's so much easier to. Okay. It's a $21 billion stock. Oh, this is a recent IPO.
Looks new.
Oh, okay. Maybe we're just missing data. This is that IPO'd in 2010. So
maybe
it
it
is
IPO'd
possible
on the U.S. markets. Maybe it's got a different ticker somewhere.
Nope. Anyways, we do have some good data on this company. Gross margin has been almost 100%. Interesting. Is that just because they... okay, so we have all the financial data. So the revenue's been growing well, but the revenue growth has been slowing down. It is a pretty profitable business. Daniel, have you looked at this one before?
No. I don't typically look into payment companies.
Yeah, what I was going to do is tie this into Payc, because Payc is like a B2B HR payment solution company that like a lot of people are super into, that I have been arguing for a long time has no moat. So what I was going to look at here is try to make a similar argument.
The one payments company that I do actually think is interesting is Four. Their ticker symbol is literally just spelt out the number 4. FOUR.
What do you find interesting about it?
They are, well, one, they're founder-led, which we all know, you and I like. And they are a payment processing company, but they also create the software. So like for a restaurant, for example, restaurants use software to basically map out the restaurant, see the table, how many people are sitting at the table, how long have they been there, is there food there, like what state of the dining out experience are they in? Basically just like picture a restaurant management software. Shift4 Payments, the ticker symbol 4, they provide that software for these restaurants and for a few other businesses. Restaurants is just the one example I'm using. So they provide that software for the restaurant. And then in addition, they also have the payment processing built into that software. So it's like they're a software provider that has payments built into their software, and they've been crushing it. So that's why they interest me, is because like they have the payments capability. They are a payment company, but like they also have the moat as to being like the software provider for these businesses.
Yeah, I think
buying. Yes, Sebastian. That's actually how I found it.
Yeah, I have a hard time seeing a moat in the software. However, if they're getting and retaining clients, it's interesting because we deal with this in Stock and Lock. Like we have the best software in a lot of cases. However, that doesn't mean we're the biggest used software, because distribution and like client relationships is obviously like very important. So that's another side of things I'm picking up in businesses like that. So like for those who invest in like Payc, this is like a B2B payments company. A lot of people were buying it right here, saying it was like a steal of a buy. You know, they had been like compounding revenue like crazy for like a very long time. But as you could see, it's gotten like a little choppy as of late. So yeah, it's just really hard to tell with these businesses, in my opinion, like how their client retention works, and then like also the switching costs for the software. It's like another big one, because there's a lot of big softwares that all do like verticalized solutions, and then like over time you'll have more of like a generalized HR solution come and just start picking things off, like Microsoft is doing with Teams, cannibalizing Slack, which is more of a vertical, for example.
The reason I think that like the general payment processors don't have a moat is because I've seen it, and like my own businesses and small businesses that I talk to, like people just want the cheapest option. If you are literally just a point of sale, someone taps their credit card and the payment goes through, then like the moat is just who's the cheapest. That's all these businesses care about. But if like for Four, I don't own shares, by the way, but like this is a company that I do think is interesting. Their stickiness is the fact that like these restaurants their efficiency literally runs on 4 software, and then they just also happen to have the payment processing. And like they're taking market share, they're signing on major clients, customers, like their revenue is growing 50% year over year. So they seem to be absolutely killing it. And the interesting thing is like the stock was trading for like 18 times cash flow with 50% revenue growth. Like that's the one that Michael Burry bought. And that's why I was like, yeah, 18 times cash flow for 50% revenue growth is pretty dumb. I can see why he bought it.
What's the ticker for this one again?
FOUR.
Awesome. I'll bring that up. Not to hop back and forth too much. My closing comments on CPay for I think Kurd was who asked. I did find it interesting. CEO owns 6%, and then I just wanted to like double check that these values were right because they were so large. It does look like the CEO has sold close to or just shy of like $100 million worth, which is fine because it's not his whole position, but I just look into that. But anyways, you said 4.
Yeah.
Okay. So you were saying that this, what was the valuation metric you brought up before for this company?
You're not going to get it on Stock Unlock because they're like, they were using adjusted free cash flow because of some acquisitions or something. So their projected adjusted free cash flow for 2024, I think was going to be like $400 million. So I took that, put it against the market cap, which I think was like 8 billion. So.
Okay. That makes sense.
Yeah.
On the screen share then. Yeah, I don't get excited about payment processing companies. I do agree with your points that there are moats to find there. I find it hard to reason with.
Yeah, they don't. It's just like I'm with you. I say like if I had to pick one for me, it would be 4. But I still don't think I'm gonna buy it because I just can't get over that where it's like, yeah, it's just another payment processor.
Yeah, well, you're also reducing your positions, which I actually think is great. So you went through great length to consolidate down.
Yes.
So I'd imagine like the bar to buy a new business is pretty high. And this is where my conversations usually end up too, is like, hey, this business seems good, or like I kind of like it, but in order for me to add something to my portfolio, it has to be like I fell in love. So like, what is your bar now to add a new stock? And then is your mindset that like you would replace the current one you have?
I would. That's how it is now. Is for me to add a new stock to my portfolio, it has to be better than what I currently own, because I refuse to buy more positions now. Like I actually would like my number of positions to continue going down over time. So it would have to be better than everything I currently have in my portfolio. Like it would literally have to replace something. And the way that I look at it now is like, when I add a new position to my portfolio, am I diluting the quality of my portfolio or am I increasing the quality of my portfolio? So I will only buy something if I believe that it increases the quality of my portfolio. If it dilutes it, then what the hell is the point in buying it, right?
Yeah, let's double scratch on that a bit. When we say if a stock's better or worse, when we use the word value, I am curious how you pull. I'm going to give you 2 weightings to pull on, and feel free to reject them or add your own.
Okay.
When I think of weightings of value, there's like 2 things. One, don't look at the valuation of the stock. Just look at the business. Is this a good business? Does it have a moat? Does it have good management? How have they grown historically? Blah, 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 blah. Just don't even look at the valuation of it. Like, is this a good company that is going to grow? Completely separately, there's the current valuation of the business.
Yep.
And I'm selfishly asking this because for my investing, I get very confuddled because I own Microsoft. It's already a double for me. I had bought most of it back in a few years ago. I think it's overvalued right now. Period, full stop. Now, I also know it's a great business. So my current mindset is like, I hold, unless if something gets like astronomical. I'm curious if, for example, like Brookfield or EQB, some of these businesses that you love them and they're great, would you completely sell out of those positions or trim them if you think that they got too overvalued to let a new stock in? Or do you compensate more for like the quality of the business once you're holding it, and you'll just kind of like stick with that?
There's no one answer here. Like every position is different. That said, every position in my portfolio I would sell at a certain price. Like if Brookfield 10x tomorrow and it became a $1 trillion company with no fundamental improvements, like business today, price 10x is tomorrow, out of my portfolio, no questions. But like, and I would do that for every stock. Like if it gets absolutely astronomically insane, then yes, I will sell it. But like, there are positions like Constellation Software in my portfolio. That one's at 35 times cash flows, but it's such a good business that I know it's expensive. I'm not adding to it, but I also really don't want to sell it. If it got to 100 times cash flow, I'd probably sell it. But like, I don't know. For now, no. But also, if Google got to 35 times cash flow, I would sell it. Why? I don't think it's as high quality. It's not growing as quickly. And I just think Constellation is like literally the highest quality stock in the stock market, which I wrote in my book. So like that one, I'm much more reluctant to sell than a stock like Google. So, you know, this is what I tell my Patreon members is like, I'm sorry, there's no one formula. Like if a stock gets to 30 times cash flow, see you later. Like that's just not how it works. Every stock is situational. It's totally different. And one thing that I've also been focusing more on in my portfolio is I'm placing more value on management and more value on my conviction slash my, I'll call it my surety level in that business. So I own one stock. Unfortunately, I can't talk about it publicly. It's another smaller one. I think that company has like world-class management. I cannot find a better management team. Well, maybe Constellation Software has a better management team, but this one is like a close second. I am as certain as you can possibly be that this business is going to be bigger in the future than it is today. I think that it's selling for a fair price. Again, it has great management. So like, I don't think that it's going to produce 20% annual returns going forward, but I think it could do like 12 to 15. And I'm very sure about that. So I've actually sold positions that may produce higher returns, but like, I think that they're more, I'm not as sure about them. Their management isn't as high quality. So like, yeah, there's maybe more returns there, but like I am so sure about this one that I've actually like sold and put the money into the one that I know it's going to be worth more in the future. So I also
like that. You said the surety index?
Yeah, like my surety level, you know?
I like that. And just to generalize it for myself and for people watching, I partially agree and partially disagree with your statement of like, it's different for every stock. It just like depends what level you're looking at. I'd say what's not different for every stock is the abstract mindset you have that valuations matter.
Yes.
There is a sell price, and then the surety index and the management, like if that were to change too, that influences it. Now, the part where I agree is, and what I think you're trying to say is the level of valuation and when you would pull the trigger on each individual stock is completely like unique to that business.
Yeah.
Flipping it back selfishly towards my Microsoft position here, like after hearing what you said, my general rule of thumb, although like I don't have a hard line, is just like, yeah, like if Microsoft started trading for like 100 times free cash flow, I think it hit like 50 or something earlier, but if it got to like 100, I'm not sure if I would 100% sell out, but like I would definitely sell a decent portion. But yeah, it just hurts when it's such a great business, but I'm also consolidating down positions as well. Ideally, I want like 10-ish.
Yeah. Yeah, I'm at, I think I'm at 16 now. My goal was to get to 15. And we'll see. I think that like as I continue to become and like grow into a better investor, that my portfolio will continue getting less diverse. It's just
And
hard.
then I was gonna say eventually you'll get as successful as Buffett, and then you'll be sad because when you're worth $100 million, your investment universe is going to shrink.
I don't think I'll ever be worth 100. There's only one Buffett. Like, man, if you read the Snowball, it's so clear that like Buffett was a fanatic about investing to the point where it was almost a detriment. Like, people were making fun of him for the fact that he wouldn't recognize his own kids on the street because he was so focused on investing and building his business. Like, that's not me.
Yeah, that kills me too. It makes you think where it's like, okay, maybe I don't want to optimize towards those
No,
things. Yeah,
no.
I agree 100%. All right, I'm going to take this one question and feel free to add anything to it, Daniel. I think we can take a few questions here from the chat as we start to wind towards a close. We actually have someone coming to like redo the porcelain on our new tub since it's like kind of chipped. So got to end in maybe like 5 or 10. But this is a great question. What do you look for in a business that tells you that business has good management? For me, one clear tell is if the founder is still running a public company. Now, let me say why. In most cases, if a founder is still running a public company, that means that they have been with that company since it was worth $0. The first one that comes to my mind is Airbnb with Brian Chesky. So that's not enough to just say, okay, it's founder-led, it's great management. But I do find a very strong correlation between companies that do well and are they founder-led. I'm not going to have a full business use case right now on like the company culture and like the vision that a founder has, but also I look at Mark with Facebook. Like when you have a founder-led company, they're able to make decisions that like larger organizations just simply can't do. Like look at AT&T, look at Intel. These are very executive-laden companies that have bloated, have a lot of internal politics, and you've seen what have happened to their businesses. There's lack of communication, product innovation starts. That's not happening with Airbnb. That's not happening with Meta. And one of the reasons why is because the founders running this business are able to make those calls. Another thing that you could look at too is like the retention of employees. You could look at Glassdoor, just like, are people happy to work there? Is the culture good? And then the last thing I'd add in before passing this off to Daniel is like, just like read the shareholder letters, like listen to earnings calls, like just human psychology. Like how does this person speak about the business? Do they instill you with confidence? Like what is your gut feeling when you hear this person talk? Do they help you understand the business? Do they make things more confusing? Like I have listened to earnings calls, like for Chewy. I looked into Chewy for a while. I wanted to invest in it. When I heard the managers talking about that business, it sounded like they'd rather be chewing on glass than talking to people on the call. They were dodging questions. They didn't seem to understand the business deeply. So a lot of it is more of a gray area, like gut feel, and you're going to get that from doing the hard work of like listening to the earnings calls, going on Glassdoor, looking at the past performance. If it's not a founder, how have they done running companies in the past? Like there's a reason why Starbucks just paid the old Chipotle CEO so much to come over, because good managers are very hard to find. Anyways, yeah, great question. It's something that Daniel and I actually talk about a lot too.
Yeah, I would say my answer is different, but some similarities. I don't necessarily care as much about founder-led. Like, it is a bonus if it's founder-led, as I said with 4 earlier, but there's also examples with like Snapchat. Founder-led, awful shareholder business, absolutely sucks, would never own it.
Fair.
Like, yeah. So it's not, if it's founder-led equals good. It's definitely a bonus, but you still got to look into it. I like high insider ownership, like Brookfield, for example. Senior management owns 20% of the stock. They're not founders, but that is heavily, like they're heavily invested in the business. It's a $100 billion company now. So that's 20 billion of their net worth invested in the company. They also have 90% of their net worth invested in the company. So like their net worth is also heavily concentrated in the Brookfield shares. So you can sleep knowing that they're looking out for their share price and they want it to go up. Because if it doesn't, they're going to be in trouble. They're going to be wiping out billions of dollars of their own net worth, right? So that makes it clear that their incentives and their alignment is 100% with the public shareholders because they are the largest public shareholders themselves. So they're going to be looking out for that share price and making sure the business does well. I also like to see low stock-based compensation. I think that stock-based compensation is important. It's something that should be factored in. When it's excessive, I won't buy a stock if it has too much stock-based compensation. Like if a company's doing, let's say, $1 billion in operating cash flow and they're doing 1.5 billion in stock-based compensation, I'm not even going to look further. It's crazy. I won't. So like every business not every business, but like almost every company on the stock market has some level of stock-based compensation. So it's not like stock-based compensation equals red flag. It's like too much equals red flag. But then what is too much? I don't know. That's up to you.
Well, the Stock and Lock Insight scores can grade those for you under the
It will
management section.
it will help you, but also like I made those insight scores, and like someone else may think like, oh well, 40% of cash flows going to stock-based compensation is fine with me, and like that's okay. Just know that's happening. 40% of your cash flow is being diluted, so factor that in. But there has been a correlation with my own investments where the best stocks that I own and the best performers and the best businesses have zero or very little stock-based compensation. Constellation Software, the company that I talked about earlier that unfortunately I can't talk about, has zero stock-based compensation. Equitable Bank is like 0.5% of earnings is stock-based compensation. Brookfield is low. And like, so I've noticed a correlation between very high quality shareholder friendly businesses and very little stock-based compensation. And like, you got to think about it too. If these Brookfield, they own 20% of the company, right? So stock-based compensation, since it's dilution, if they do an excessive amount, who are they diluting? They're going to be diluting themselves. So I've also noticed a correlation between high insider ownership and a heavy reluctance to do stock-based compensation. Because again, they're diluting themselves. So those are things I think about, look at. And then also like I go back and take a look at, okay, 10 years ago, what were the projections they were putting out for the company? And did they hit them? Did they beat them? Or did they completely miss? And then how consistently do they meet or hit expectations? Yeah, all those things.
I'll dogpile on that with you on the point we really agree about. I just always think of the Charlie Munger, show me the incentive, I'll show you the outcome. Like look for businesses that incentivize themselves in ways, whether that's through like high ownership, like low SBC, as Daniel's talking about, even in terms of like what the metrics are. So one thing to look out for, if a company is driving towards adjusted EBITDA metrics, look into that. How do they calculate adjusted EBITDA? What are they taking out of that? Is that actually a shareholder friendly number, or is that just kind of people like scratching their own backs for Wall Street performance and analyst ratings to go up? Just about to use an example.
My favorite is like, if you take a look at Adobe, for example, they report their operating income and then they report their adjusted operating income, which is just like, just forget about stock-based compensation. Let's just remove that number quick. It's like,
yeah. So here's what I like. I put a small position in a company called CEIX. They're like a coal, they're a coal mining company. Basically, they own a couple ports. Free cash flow yield was like 25%. They were either buying back shares or paying a dividend. Like lots of good actions there. And when I listened to the earnings calls, like figure out how this management company thought, they incentivized themselves and had some like very fair like bonus payout targets and like compensation numbers. And the metric was free cash flow per share.
Yep.
Not adjusted free cash flow, not EBITDA, not just what the net free cash flow was, because you could build up tons of free cash flow, but then also give out tons of stock-based compensation or like have shareholders be diluted. And that's not shown there.
Yep.
So that for me was like, wow, this management company actually really understands true shareholder value. And beyond that, even in terms of like how they gave that money back, they walked through their mindset on like, this is when we'll be buying back shares. This is when we'll be paying a dividend. This is like how we view our stock valuation. And like, this is the metric we are looking at. I'm like, great. If you look back historically, they had done well there. So awesome, dude, this could be a book on its own. I feel that we're starting to wind towards a close here. I got to head out in a couple minutes. Do you want to take any last questions here? Daniel, looks like Swapnil has been posting a question. Seems like they want to ask you.
Do you get tempted to swing options or leaps for fundamentally solid companies? No, I don't do any options. So I don't even know what this means. I think that's my answer. Like, I've debated looking into options before because I've heard that you can like get income from selling options or something, but I just think buying stocks is so much simpler. So I haven't gone into the options hole yet.
Yeah, I kind of get this question. I mean, no to swinging options, but yeah, the covered calls and puts could potentially work. But
yeah.
All right, I think that's all we have here. We usually go super off topic for the last minute or two. So Daniel, we'll let everyone know. I'm super excited. I'm traveling to Europe. My sister moved to Portugal earlier this year, which is extremely exciting. So I will not be here. Yeah, dude, she's liking it. She's like the free spirit out of us. I'm the oldest of three kids, and my youngest sister is always kind of just been the free spirit. So she's out there in Portugal. And Daniel, you know this. I do enjoy beer sometimes on my time off, and we will be going to Oktoberfest in Munich. So if anyone has been to, oh dude, I'm hyped. If anyone has been to Portugal, or if anyone's been to like Oktoberfest in Munich and like has suggestions, drop them in the chat. Or if you're not in our free Discord yet, hop in there. We're going to be continuing the conversations about lots of the things we discussed today, and I'll be dropping the link in the chat. I think most of you are already there, but it's a great place to hang out.
Someone said they're from Portugal. Nuno Cruz.
I'm flying there tomorrow, Nuno. So look for this. Look for this caveman. It's like you got clean cut Daniel on the screen, perfectly manicured hair, looking very, very nice. And then you have his business partner who just literally came out of the woods. And now I can't even shower because they're about to redo the porcelain on the tub. So might have to go to the gym for that.
Well, we also got a comment here. You have to visit Porto and Douro Valley.
All right. I'll take a picture of this on my phone and send it to my sister. Thank you.
Heck yeah. All right. I think that's it.
Yeah. Well, thank you everyone for tuning in. This has been Stop and Lock Podcast episode 57, where once a month Daniel and I hop on here and honestly just have conversations live recorded that we'd be having with ourselves with you. If you are listening to the recording on Spotify or Apple Podcasts, come hang out with us live sometime. And for everyone who is on Stop and Lock, as always, we appreciate the support, and we'll be back with you, I guess, in October. So looking forward to it.
In 1 month. Yeah, let's go.
1 month.
All right.
Awesome. I'm pressing the button.
All right. Bye, everyone.